Welcome, everybody, to Secret Sauce, the show where we hear real-time insights from industry leaders. I'm Karly.iacono. Today, I am so pleased to be joined by Kevin Fagan, the Senior Director at Moody's. Kevin, we are beyond excited to hear your insights on the current economic situation. Thank you so much for joining us. How are you?
Great. Thanks very much, Karly. Happy to be here.
Wonderful. So before we jump into all of the knowledge that we are dying to hear about what's going to happen, because I am sure your crystal ball has been looked at over and over again this last 12 months. So we're excited to hear what you think moving forward. Before we do that, tell us about your role at Moody's. Just give us a quick background on who you are.
Sure. I've been at Moody's for about 12 years now. I sit in the Moody's Analytics commercial real estate team, which kind of started about 5 years ago, and been here about a year and a half now. Before that, for about a decade, I was the head of research on the CMBS side, the rating agency side of Moody's. So basically a credit analyst with, fancy research things laid on top of that. And before that, I was a structural engineer for a long time, but I started dabbling in real estate investment, and I really liked the analytical side of it. And I realized that I could go and make money without having the risk of killing people via failing in structural engineering. If I make a mistake in economics, it's not as bad as if I make it in structural engineering. So I'm very happy to be on this side of the aisle.
That's really funny perspective. I'm sure many people would still be upset if you made mistakes now, but yes, maybe slightly less physical implications there. Too funny. So when you're in your day-to-day role at Moody's, are you looking across the complete commercial real estate spectrum? Are you going asset class by asset class? Kind of what does your day-to-day job look like there?
Sure. Yeah. It is really the full entire spectrum. I mean, what we are is basically a data provider similar to, your CoStars and your RCAs and CBRE actually. But we do provide an analytical engine on top of that data. That's my economics team. And so we do forecasts on space market, things on basically all property types. Some of the ancillary ones, not quite yet, but so we also have, price indices, and we do forecasting on those. But on a day-to-day basis, my team, we do a lot of research, and we try to address contemporaneous issues that are going on in the market that our clients care about, mostly using our data, but not always. But that's pretty much the day-to-day, but there's a lot of noise around that it kind of reflects the CRE sector overall. It's very heterogeneous, and there's a lot going on. So at any given day, you could be working on something completely different.
You have to be more in demand from a knowledge and research perspective than you have been in quite some time. I can imagine your phone is ringing nonstop for requests to speak and requests to give commentary, because the economic uncertainty, at least from my perspective, is really the biggest factor impacting the market right now.
Yeah, I think that commercial real estate has gotten a lot of headlines lately. It has been 3 straight years of that. COVID really it ramped up substantially, and at that point in time, I was on the rating agency side of Moody's, and really your job over there is to contemplate the downside of everything. So it was quite busy during COVID, and almost immediately during that time, the questions popped up about the office sector. And we did a really in-depth analysis of remote working and its relationship with office utilization and how tenants take down space, back in 2020. And that conversation has definitely evolved, but definitely continued over the last 3 years. And I think the headlines lately have a little bit more to do with, fear of systemic risk. Every general is fighting the last battle. And so a lot of people that were around 15 years ago are thinking about real estate with pretty negative connotations. With changes like the office usage, interest rates going up, which does, impact commercial real estate pretty directly. That's really pushed CRE right up into the headlines. And it's also been right at the top of, regulators' watch lists. So you're right. It has been very busy times the last couple of years.
So I want to start with your view on economic policy moving forward instead of looking backwards. So what do you expect to see in the next 12 months, and how do you think, broad strokes, that will affect commercial real estate?
Sure. So right now in our baseline scenario, let me just back up a second and say, within Moody's, one of the great things about being here is that, because there are so many ways that Moody's integrates into the economy, we have experts all over the place. We have banking experts, we have a macroeconomic team that does, the macro level forecasts, and that'll flow downstream into CRE models, but we work with them a lot. And we have, retail experts, REIT experts. So it's really great to pull from all those resources. And one of those resources right now is the macroeconomic team. And right now in their baseline scenario for GDP, they're expecting 1.1% in 2023. And that really is assuming no recession this year. So in other words, I think you might have were planning on asking me about this, but one of my colleagues here, I think, coined the term slow session. I'm not totally sure about that, but he certainly has been using it a lot. And he seems to be the one who said it. But the slow session model of basically the Fed being able to slow down inflation and slow down wage growth without actually damaging major parts of the economy is the baseline scenario right now. And of course, there's plenty of scenarios around that where oil prices spike and remain elevated, and we can't get that inflation down from that. So there's many downside scenarios, but in the baseline scenario, we're not expecting a recession this year. And so in that case, what that means is, in terms of inflation and the treasury rates, is that we have a gradual quelling for the rest of the year of inflation via interest rate hikes. So we have another maybe 20 basis points on average to go by the end of the year, 25 basis points on average to go by the end of the year. And then finally, in the beginning of next year, we start to come down on interest rates and normalize to somewhere between 3.5 and 4 for the 10-year. I think
two follow-up questions. I got to jump in really quick there.
Yeah, sure.
Is slow session the same in your mind as soft landing? Because those have been the two buzzwords I've heard the last few months the most. Or are we differentiating soft landing and slow session?
I think it's a better branding term, slow session.
Okay. So you like it because you guys coined the term, but it's actually the same thing. Is that what we're saying? No.
I
Slight
think
differences?
Yeah, I think that it's probably, for all intents and purposes, it's probably the same thing.
Okay.
I mean, it's more or less saying that we're not throwing ourselves into a deep recession,
Right.
and that monetary policy can navigate that.
Okay, fair. Now, the 25 basis points you said you believe we still have to go, which is pretty widely held view. Do you expect that to be coming out in May, and then the Fed to stabilize and not change rates for the remainder of the year? Or do you think that might be coming at a later time?
The sentiment seems to be, and these are really difficult things to forecast in terms of decisions that are made by the FOMC, but the sentiment does seem to be more that we've gotten more dovish. Certainly, the expectation of a cut. Actually, the Fed tracks that the expectations of cuts in the upcoming FOMC meeting, and the expectations of cuts have gone up substantially. Actually, right after the SVB banking crisis situation, they inverted, where the expectations of cut went higher. So we've gotten more dovish, but the Fed really has to commit. There's a couple of things that are the last bit of inflation is the hardest to get quelled. What's called super core inflation. That's the part of wages that are non-household oriented, service oriented jobs. So that wage increase on there is still very high inflation, and that's the hardest one to get down. So that super core is something to watch out for. The Fed has actually noted it multiple times that's something that they're watching. So there's just a lot of things to watch and to be able to address, when and how much it's going to continue to happen. But certainly the Fed doesn't seem like it needs to push the brakes right now. primarily because what's caused the slowdown most recently is the banking crisis. And that does seem in a lot of different ways to be under control.
Good. Okay. That was a question I was going to bring up later, but let's go into it now. So
Sure.
you feel that the recent defaults, I guess we're at 3, and then of course the Credit Suisse buyout, those were all isolated incidents and it's not a systemic banking risk.
Yeah, and I actually, I feel nervous even saying that because that's the kind of talk that you hear right before a major crash. So
And then we play out the soundbite. Remember when you
yeah,
no, we
exactly.
won't do that.
But the reality is that there's some really core metrics to look at that actually matter, there's been some kind of misreported statistics out there about commercial real estate's reliance upon regional banks and vice versa. I think it's just a fundamental misinterpretation of the data. But bottom line is that regional banks only account for about 13.8% of core stabilized income generating CRE borrowing. So there, in other words, there's a lot of other lenders out there besides regional banks. And on the flip side of that, the regional banks' direct exposure to CRE is about 16.5% on average. There's some banks that look like they have a lot more. Exposure, and so there might be some idiosyncratic trouble in there. But the big banks don't have a lot of exposure at all. They think they average around 4% of their total assets are CRE, and then, like I said, 16.5 for the regionals, and then maybe a little bit. There's I think it's 23% for the community, like the much smaller banks. Mm-hmm. But the point is that so those exposures not as much has been largely reported, and also lending leverage has been significantly less this time around than it was pre-GFC, 15 years ago. Right. So it's 5 to 8% less points of LTV. And on top of that, on the bank side, there's much better capitalization rates. The tier 1 capital ratios are higher. The liquidity facilities that are available for banks to borrow in the case of runs or liquidity issues are much better. They just the Fed just opened one called the BTFP. And that one, the banks can borrow for up to a year on book value of their assets rather than, mark to market value. So that's a big deal, Mm-hmm. So there's a lot of structural things that are different now than 15 years ago, on top of the fact that the exposures are generally less. So I think, in terms of CRE being a catalyst for further banking issues, I don't see that being an issue. I'll caveat that by there could be some, accounting losses, regulatory accounting losses that banks have to take on their books that don't have to do necessarily with actual realized losses, on these much lower LTV loans. So there could be some noise there, and that's one thing that we're keeping a really close eye on and working with our banking team on.
Very interesting. And I think the general public obviously would have no idea or transparency. They would just see the headlines that there was trouble, but maybe not really understand whether it was tangible or not. So thanks for illustrating that. Besides loan to values being different than 2008 era, what other differences do you see? Because everyone loves to compare the two, right? This is not going to be the crash. The financial system's much more stable. I'm seeing from the transaction side that lenders are much more conservative. The covenants are much stronger. So it's not just a rate discussion. They're being a lot more cautious with any deals they're putting out, which of course is slowing down the market, which I don't love. But I guess you could argue that it makes the system even stronger relative to other periods in time. Any other differences that you've noted?
Yeah, I mean, you're kind of hitting on the financing gap that's going on right now. So, that I guess I would say we're not saying just because there are structural differences that are mitigants against that kind of downturn. There's certainly issues coming up, and we're going to see some loan defaults. We're going to see some, workouts and some extensions, and we'll definitely see default rates go up with the maturities that are coming up. But to your question, one of the other big things that's different now is pricing was, typically through real estate cycles, pricing gets very tight towards the end of the cycle. Your cap rate spreads over treasury get very, very low, sub 200 basis points. They averaged about 200 basis points in the 3 years in the run up to the GFC. But then that big period after the GFC up until COVID, cap rate spreads were really averaging about 300 basis points over Treasury. So they really didn't follow the Treasury all the way down. And, the Treasury was somewhere around 2% during that 2013 to 14 vintage era that's kind of maturing in the next year or two. So that 2% goes up to 3.5, but you had a lot of cushion in your cap rates there. We didn't get really aggressive pricing. So on average, that's a much better thing for the market to be able to kind of skate through a down cycle that we're definitely going into a down cycle. But the ability to be resilient through that down cycle is enhanced by things like better pricing.
So rapid fire, interest rates or cap rates higher or lower in 12 months?
Higher.
Higher and higher.
Yes, both higher.
Got it. So you started to allude at the beginning of our conversation to 2024,
right,
and we kind of moved in a different direction. So let's project out a little farther. When or do you expect rate cuts to happen?
Yeah, so right after that 12-month period.
Got it. Okay.
That's where we have that. That's where we have them peaking out. That's where we have Treasuries peaking right now is the end of this year, beginning of next year, and then starting to come back down. That's our baseline scenario, and there's a reason why we have about 12 different economic scenarios. It's there's a lot of things that are out of control of your model. Yeah, exactly. And so the scenario analysis just help you, think through things. But, in the case of a recession, our Treasury forecasts go down pretty precipitously. I mean, that's effectively the point. You're building in the ability to lower those when you need to spur the economy again in a case of a downturn. So, again, our baseline is about 12 months from now is when they're going to start stepping back down. And cap rates, notoriously don't move in lockstep. It took them about 2 quarters to finally start reacting to the interest rate rises in 2022, and finally they started drifting up. And actually, one of the challenges I think for the market is the positivity around multifamily. On the space market side, that's pretty true. Like, you still have a supply-demand imbalance. Although we have a lot of pipeline coming through this year that could, be a pretty big issue. We're going to see what happens in the next quarter, but that can really start to make vacancy rates start to push up in multifamily on the space market side. On the capital market side, the pricing has still been quite tight, meaning that cap rate spread over Treasury has still been very tight. Even as the Treasury has started to go up. So, that does not bode well if you have a price correction in multifamily. When you have low cap rates like that, going from a 4 to a 5 is a lot different than going from a 6 to a 7 in terms of your value loss.
Right. So we cannot just cover multifamily. So now that we went asset type specific, you're going to have to give us some nuggets on retail, industrial, self-storage. Just let's lay the rest of them out there. Office. I know you like to talk about office, so we can throw that one in too. It's not my chosen asset class, but let's cover them all.
Sure. Well, you started with retail. I'll go to retail. We've definitely seen it's come to full fruition the separation of the haves and have-nots in that market. You don't rarely even have that conversation anymore about experiential retail is better and retail is still necessary. Like that was a conversation for about 7 years ago-ish still,
right?
But that's sort of faded out because there's a real recognition that retail is a necessary part of human society. But we have really started to see the reinvention of the malls, where those malls are no longer just dependent upon the demand driver of the department store. That business model is long gone. Now you have to have many different demand drivers to your mall, and there's been some really good operators out there getting really creative, including incorporating some logistics. Malls are typically located within the bulk of the population of a metro, and that's a good thing for industrial. So on that, I'll switch to industrial.
Wait. I just have to say one thing about retail, because this is my bread and butter and favorite asset class. that, I think it's fascinating. We are seeing the lowest vacancy since 2005, since CBRE started tracking the metric. And the conversation is so much broader than just malls. Malls are an easy thing to kind of point to because they represent so much square footage and definitely change in shopping patterns. But the neighborhood retail seems to be performing really well. Single tenant is off the charts. So I think it's a broader conversation of integrating the retail into the community more than just focusing on the regional malls. So I think I just wanted to say, I believe the picture is even brighter when you dive into it a little more into sort of the subsets. But maybe I'm
Yeah, I
wrong.
kind of skipped over that, and that's actually, I mean, I'm glad you went back to it because that's a really good point. I mean, one of the big buttresses for retail overall is that the lack of construction has let
Right.
demand kind of backfill that space quite a bit.
Hmm.
And yeah, the different types of retail, I think this is one thing that we're, is a challenge for us is thinking about how to redefine property types in general, but also
Hmm.
retail. Retail is a very, you know, is it high street? Is it second floor? I mean, pricing is so different based
So different.
on, the product. And so lumping it all together probably isn't doing it justice. And we probably need to move away from just covering those neighborhood community centers and calling that retail. You're totally right about that. But that NCS, that neighborhood community shopping center, slice of retail has been pretty sleepy. Vacancy rates, you know, fine. I mean, I don't know if we saw the same statistics that you did in terms of the 2005 thing, but we've seen good performance in retail, and it has a lot to do with that lack of new supply. And although coming into a recession, it can be a tough asset class without a lot of necessity good kind of anchors, because as go retail sales, so goes the retail real estate market.
I think we have enough tenants vying for space to backfill any turnover, but we'll see. See
Yeah.
how it goes. All right, industrial, go for it.
Yeah, industrial is really the best asset class right now out of the core by far. You have a pretty good picture on the space market side. Just still a supply demand imbalance where we've seen vacancy rates as low as they've ever been for the sector. And then we still see positive rent growth, although that's been declining, as the economy has been cooling off. So and the inflation has been coming down. So is the rent growth for industrial. But it doesn't seem to be a real systemic issue, regardless of headlines about Walmart and Amazon pulling back on space. The demand for that space is just still very, very strong. And it's hard to create new space. You got zoning limitations, you got employment issues. So, most of the tenants that want that industrial space want to be located in a pocket of very good employment, and it's hard to find those places. So that's the real challenge on the development side. And then on the pricing side, we're really seeing aggressive pricing, but it hasn't been absurd. There's been kind of a shift where industrial was always like this 9 cap sort of industry, and now they're down there playing around with multifamily, but not quite that tight, and have kept a pretty healthy spread over Treasury, especially considering it's an asset class in such demand. So for now in the near term, industrial is very, very strong.
All right.
Hotels,
No concerns
sorry.
there. It sounds like just strong on all sides, just maybe lack of supply. Got it.
Yeah. Well, I mean, further down the line, whenever drone deliveries become, all the rage, that might
Common.
cause some functional obsolescence. But we'll see how that plays out. So yeah, I think maybe I can touch on, before we go into office, I'll touch on hotel real quick.
Sure.
Hotel is really still riding the revenge travel wave. We've started to see more volatility in that space for sure, but it's still right up there with peak all-time RevPARs. If you look at the NACREIF index, it's the only one with total positive returns right now for 2
Wow.
quarters in a row. None of the other asset classes, all the other asset classes have gone negative. So you can see from the TSA travel numbers that we're still 110%, I think, of 2019 travel, and that's reflective of a major shift in the economy from goods spending to services spending, and so the hospitality industries it needs a break. It had a pretty rough ride during COVID. So, the sector is feeling in the upswing still.
How sustainable do you think that is? I mean, obviously, I'm not looking at this every day like you are, but it
Yeah.
seems to me that that would be one of the first types of spending to be cut out if this slow session, recession, soft landing, whatever it ends up being happens. I
Yeah.
would see discretionary spending like travel and hotels really dip down. Are you expecting that or no?
It absolutely will. Yeah, I
Yeah,
mean it's the most pro-cyclical, meaning it
right.
moves with the
Hmm.
economy, and so you don't have leases in place. There's not an inherent need for it,
Right.
typically anyway. And so yes, it's a discretionary spending with no leases in place. It moves pretty quickly, and it probably will. I think kind of one of the more interesting stories about it is the debate over how much business travel will be cut
Mm-hmm.
permanently going forward. I don't think we've seen that play out yet because post COVID there was a lot of desire to get out and travel more, even among business, and that so the airport hotels haven't been doing as bad as you might expect. Because so much more work can be done remotely. We did our tourism group actually did a really nice study where they came out to be about somewhere between 10 to 20% permanent decline. And they broke that out by segment of demand, a segment of travel type, business travel
Okay.
type, and then benchmarked, via industry expert surveys on how much they thought that would get pulled back on. And so they landed around 10 to 20% permanent decline. So maybe coming out of this next down cycle, look out for that.
Seems seems reasonable, logical.
And then finally, the favorite topic of the last 3 years probably has been office.
I
So
don't know about
we
favorite topic, but maybe most talked about, most stressed about might be a good way to put it.
That's true. The most popular topic has been office, and right now, a sneak peek, it looks like we're going to be we're going to be at about 19% vacancy rate on a national average, which is just shy of our all-time high vacancy rate in 1991, which was a pretty stressed period, following the 1980s period of overbuilding and the savings and loan crisis. So it was a pretty stressful time. So it's telling that our vacancy rate is getting up to there, but we do have it continuing to go up by the end of the year. I think we're going to peak at the end of the year, flatten out over 2024, and then start to come down by 2025. And the reasoning behind that is that construction has really pulled back
Mhm.
quite a bit. And I think that although the relationship between employment and office using employment, like the total amount of it, and office performance is loosened a little bit, that relationship is loosened a bit, but it's still there. And so construction stops. The fastest growing segments of the US economy in terms of employment are the office using employment segments. And so that will continue to backfill, not unlike retail. The story is sort of similar. It's not functional obsolescence, it's reinvention, it's adaptive reuse. And so we will see that kind of come back in office. And then in the interim, we probably will see some, real pricing differentiation between the higher quality assets that have more desirability for tenants for a number of reasons, and then ones that don't. So that's basically where the numbers are for us. I think that we'll probably hit that peak of 19.3 by the end of this year. Probably we might even exceed it, especially if there's a downturn. Oh, that's one other thing I wanted to mention is that our downside forecasts for office are much more stressed now.
Mhm.
So in our kind of severe downside scenario, we have vacancy rates going up to about 23%.
Okay.
And the reasoning for that is basically that, while remote working has been around for a little while, there's problems with it. You can't have everybody really be remote 100% of the time for all kinds of reasons. But the reality is that whenever you come up on a lease expiration during a downturn and you're in survival mode, and maybe you don't want to lay off a certain amount of people because it's expensive to hire them back, and you want to be ready for the coming out of the downturn. maybe you go remote. And we think that's very likely that companies make that decision, and downturns going forward, making office a higher volatility on the downside going forward. And so we've started to reflect that in our downside forecast scenarios.
Yeah, I think that makes a lot of sense. Thank you for adding that commentary in. I don't want to get too in the weeds on office, but I do want to ask you, are you seeing regional differences? Because it seems, when I travel, certain offices are absolutely packed. Certain areas, it's just culturally maybe not as steep of a return to office. So have you noted any significant geographical differences?
Yeah, in terms of the utilization rate, which we haven't quite we don't have a long enough history yet to see how utilization rate is going to relate to occupancy rates. But
Okay.
in terms of utilization rate, we've definitely seen regional differences. Even stepping back globally for a second, in Asia, they're back to about 85% right now. In some places, 90.
Wow.
So there's just a cultural difference there.
Right.
You need to be in the office, period, and that's the culture.
Mhm.
Here we're seeing it's interesting, the kind of getting some mixed messages actually. So the Castle data that everybody cites, that are the badge swipes, showed definitely in the early days, it was more the South, the southern states they made a bigger comeback, and they still kind of show that. And then there's some other data that's cell phone data that tracks, how long you're in the office and how many people are in the office at any given
Right.
time relative to pre-COVID. And that really suggests actually more office utilization in the bigger major metros on the coasts or Chicago, which is a little surprising. There's some mixed messaging going on there, but generally speaking, there is a better overall office picture going on in the South, and especially the Sun Belt. So that's just kind of mirroring some business migration, population migration. We've seen the thing is if you look at our rent growth by market, I think we cover 82 markets. If you look at the dispersion of rent growth, year-over-year rent growth in office, even in 2022, it's really widely dispersed, where you have some really healthy office rent growth in some of the Sun Belt markets, and actually over on the Southwest as well. But a little bit of weakness in the Northeast, a lot of weakness in San Francisco. So there's major regional difference in overall office performance, and that does kind of line up, it seems like, maybe with the utilization rates.
Data is so much fun because you can slice and dice it a million different ways and tell a different story, right?
Yeah.
I think your job is difficult to really tease out the true trends and not focus on one metric or one way to look at it too much.
Absolutely. And I think that, in terms of opportunities and positive things going forward, I think you can take something from the office sector in the sense that, there's going to be distress coming up when these maturities come through. Some of them are going to have to be REO and sold into the market. And I think that the repricing that happens, almost all the banks that we've talked to that are our clients have almost ubiquitously agreed that there's no functional obsolescence for the overall sector. There's no issue of that. I mean, clearly there's some properties that are outdated that, need major renovations, and those are functionally obsolescent probably. But just overall for the sector, not a story about functional obsolescence, but more of a pricing story,
Right.
like a repricing needs to happen.
Mm-hmm.
So lenders have told us they'll feel much more comfortable lending on office when it gets the repricing on the order of 20 to 30% happens. So, when these refis come through and there's that repricing that needs to happen, defaults happen, there's going to be a lot of opportunities in the market, to scoop up assets that can be positioned well, still as office, maybe mixed use. That's another really kind of interesting positive, of what's happening right now, is that times like this offer the ability to reinvent the urban fabric or how properties are used. So I do think that you mentioned earlier, incorporating the retail more into, that's part of the New York's 40-point plan from the governor and the mayor here, to, reinvigorate the city in terms of, having mixed use properties, having the multiple uses within one property rather than one office building, diversifies your risks, offers a more more vibrant community. So I think that's a kind of an interesting, positive, where the way that cities evolve after COVID and after, remote working becomes whatever its final state is for us.
I want to zoom out from office. I have two more questions for you before we wrap up today. The first is, what is the biggest challenge you are facing in your business, and how are you overcoming that? You have a, I think, very difficult task of taking a confluence of factors and making sense of them and making predictions that people weigh on heavily. Is there a metric or a data set that you're less clear on than others, or a part of what you do day to day that has just been especially challenging in recent times?
Yeah, I think the main challenge, the main existential challenge is data. So we're still in the relative nascency of the CRE market as one of the major investment markets compared to other asset classes. I mean, it's been a private market forever. The last 20 years have helped a lot with different kinds of sources of data that have been able to give a lot of transparency to the market, but that transparency is still a big challenge. So take office for a second. One thing that we don't know, we don't have a database for, and we're trying to build, is what happens when a tenant's lease expires. Where did they resign? Where did they go? We have data on new lease signing. We know what happens then, but we don't know what happens when the lease expires. And so we've been doing painstaking work to try to track down, making phone calls to brokers, Googling. We're trying to aggregate data of what happened to tenants when they leave, because it's an important question right now. We need to know, are tenants really en masse? I mean, we got little, samples here and there, but we'd like to have a big, broad view of it. So that's been a challenge. The banking crisis recently, we don't have really strong data looking into what the loan metrics are by bank. And so when we're trying to see stress by bank, we can see exposure and maybe property type. And we have access to this now, but we're working on getting some, more credit metric kind of stuff. So the data question is always the issue, trying to get more and more transparency to understand the market better. One other way that's this is coming, and this is brand new really, is understanding how climate is impacting real estate. And this is a much bigger issue than I think is typically talked about in real estate circles, although it's certainly increasing. So we have some in-house analytics and data now for this. And what we're starting to see and what we're starting to track is insurance costs. That's the first way that we're starting to really see it. Sure, you see losses and from Harvey in Texas, but losses are kind of ambiguous. Like, why did they happen? Was it because of that specific storm or whatever? You can kind of talk yourself out of worrying about that. It's something off in the future. But right now, the protection that you typically have against physical climate issues or physical issues at all is insurance. And so those insurance prices are going up. They've hockey sticked substantially over the last 5 years. So typically you underwrite about 2 to 3% expense increase on your insurance costs. Now the average of that has been somewhere between 8.5% and 10% over year. And it's like 15 to 25% actually for areas of really high risk. So this is a major issue for the industry. I just saw a headline today that's been slowing down some deals, specifically because of the insurance cost issues. There's no
How much of that is valid, though? Do you think that's, and we could do a whole nother show on insurance and costs and so forth, but is that a measure more of inflation and just lack of competition in the industry, or do you actually think that's environmentally connected?
It's definitely real. So I do a lot of work on this. Like, I guess one of my side jobs within this job is I'm a primary person for dealing with, how climate and ESG, which is a separate issue, fold into real estate analytics and underwriting. And, on a lot of committees and stuff on this, and we've talked to a lot of insurers, and we have RMS is a company that's a modeling company for insurers, and Moody's acquired them a couple of years ago, and we've been working with them quite a bit now. All their clients are insurers. It's very real. We have a lot of evidence that the insurance markets are kind of in turmoil, and they need to protect themselves with higher premiums. So, Yeah, so it's definitely, and by the way, there's availability issues too. So, Florida and Louisiana are really kind of suffering right now. Louisiana, for example, you can't get a private market named windstorm insurance policy. You have to get it from
Mm.
the public markets, which are actually more expensive. So it's a big issue. I think, it's just something that used to be you kind of like not pay attention to it. We're getting past that point now.
Glad you brought that up because that was not something that I had considered. So thank you. I guess we need to put that more on our radar. I would
It's a big
love for
deal.
you, before we wrap up today, I would love for you to leave us with a bright spot, something positive or a silver lining in all of the turmoil and volatility that we've all experienced the last 3 years, really. What is the silver lining or something good that's going to come out of all of this?
Yeah, I mean, I have a lot of positive things to say. I have a hard time even picking one, but I think that, two of the biggest I've already sort of touched on. One is that, we always go through cycles, always, and cycles offer opportunity. And I do think that there's going to be a lot of good buying opportunities in this down cycle. And I also think that credit is actually not that bad. I think, we could have a situation where we don't take extreme severe losses like we have in certain other cycles, while also kind of doing appropriate repricing in areas or for assets where that offers opportunities for new buyers to kind of come and rethink the property or renovate the property or reposition it. So I think the distressed opportunities are actually a positive, and just part of the business. And the other thing I mentioned before as well is it's going to be really interesting to see how cities evolve. I think that there's an opportunity for cities to do a little bit of reinventing that can be positive for the urban fabric. And I think the mixed use story, the adaptive reuse, can keep cities vibrant. And just shifting the uses a little bit.
I've always felt that stress and volatility breeds progress. And
Yeah.
when things are humming along, that's it. You get more of exactly what's happening because there's no push for change. So I share that viewpoint. And I think although it's been difficult for a lot of people in a lot of different sectors and parts of the business, I think it's going to be very interesting to see how all these different property types emerge on the other side.
Agreed.
This was fantastic. It was a lot of really, really insightful market data. I'm so happy you were able to touch on each asset class and then also your big picture viewpoints. Kevin, thank you very much for joining us today. It was really a pleasure.
Thank you, Karly.
To everyone listening, that was Secret Sauce. We're so happy you could join us, and we look forward to seeing you again very soon. Take care, everyone.